Welcome, traders and enthusiasts, to a session that promises to empower your trading journey and elevate your analytical competency. My name is Ali Mortazavi, the head of training and education at Arante, your guide in this endeavor. And today, we turn the complex into the comprehensible, the data into decisions, and charts into choices. This webinar has been brought to you by Arante, which is an online broker committed to providing top-tier services and building lasting and trusting relationships with clients and partners. Please be informed that the strategies, insights, and analysis we will explore today are built upon rigorous study and market observation. However, they come with no guarantee of future performance, and each investor's diligence, informed decision-making, and consideration of personal risk tolerance are paramount because CFDs are really complex instruments and come with a high risk of losing money rapidly. So you should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. And this is what we are trying at Arante to make sure that all of our traders can learn continuously about the financial markets to decrease the level of the risk that is associated in the trading journey. Okay, just before we start our webinar today, please let me know through the chat box if you can hear me and see my presentation, this outcomes agenda very well. So that would be a comfort for me to start without any further ado. So I appreciate if you just write down a yes or type an okay or something to let me know if you can see my presentation and hear my voice very well. Okay, thank you so much for a couple of confirmations that I get. So I assume everyone can hear me very well. So let's start without any further ado. Yep. Okay. Okay, thank you so much, Mr. Othman. Perfect. Okay, after all, let me welcome you again to our webinar focused on the art and science of technical analysis in Forex trading. It's going to be our first session of the new package about the technical analysis that we will be providing for the next few webinars. And today we embark on a journey to untie the complexities of the market and harness the power of analytical tools to enhance your trading acumen. We begin by laying a solid foundation with an introduction to technical analysis. This segment will transport us through the historical evaluation of the crucial discipline, illuminating its relevance and applications in today's dynamic trading environment. And we will try to focus on the modern concept of technical analysis, and you will gain a clear understanding of how technical analysis informs strategic trading decisions for us. Next, we delve into the core principles of technical analysis, and you will learn about the crucial elements like price action, volume, and trend analysis. And through real market case studies, somehow on the MT4, I will try to just demonstrate these concepts on the chart, and you will see the implication of them as well. So our exploration continues with an in-depth understanding of the business cycle's 6 stages. This knowledge is key to forecasting market trends, allowing you to tailor your strategies in alignment with each stage's unique characteristics. Then we examine the critical role of market psychology in influencing price action. You will see firsthand how factors like investor sentiment, fear, and greed can drive market fluctuations, and how we will be able to identify and measure the level of the market sentiment using the price charts. And this is when uh, comes to momentum in markets in our next focus. This segment will equip you with the skills to use momentum indicators effectively, to understand them and comprehend them in a way that can provide you insights into potential market behaviors and trend predictions. Okay, so mastering different chart types is essential for any technical analysis, and this section will enhance your ability to interpret various charts like line charts, bar charts, and candlestick charts, and understand their significance in different market conditions. Then analyzing market trends is an art in itself, and you will learn to identify and interpret various market trends, such as primary, secondary, and minor trends, and grasp their importance in making informed trading decisions. Finally, our interactive Q&A session will provide an opportunity to engage directly with the material. So it's your chance to clarify complex concepts, ask questions, and apply what you've learned to real-world trading scenarios. You can just write down your questions to me through the chat box or the question box of this platform. So as soon as they arise, and I will try to answer them at the end of this webinar. Great, so let's dive in and unlock the secrets of technical analysis, equipping you with the knowledge and tools to trade with confidence and precision in the Forex market. Okay, on this slide, we delve into the core principles that form the bedrock of an analytical approach. These principles aren't just methodologies, they are a way to understand the very heartbeats of the markets. Let me just turn on my laser point that would be helpful through our explanations. Okay, the core principles revolve around the deep understanding of market trends, the critical role of volume, and the intricate study of price action. These elements are the pillars upon which sound trading strategies are built. So let's unpack this a bit. Market trends provide insights into the direction and the strength of market movements, offering clues to future markets behavior. Volume, often an overlooked aspect, especially in Forex trading, is a crucial factor in confirming these trends. A high volume on an uptrend suggests a strong buyer commitment, whereas low volume might indicate a lack of conviction. So we always use the market volume as a confirmation tool. And then there is a price action, the study of historical market data. It's akin to reading the market's past diary entries and to anticipate its future moves. So through our webinars about the technical analysis, I will make sure that we are going to learn uh, comprehensively about all of these aspects and principles of technical analysis. And you will see at the end of this package, after 4 webinars, that how we can identify the market trend as best as possible, and we can confirm it using the various tools, not just volume, but the many different tools uh, to see if we are going to have a reversal or we are going to have just a continuation in our prior trend. And then you will learn very, very useful and common price action techniques, and you will learn how to understand the market psychology using these practical methods. So in practical terms, these principles guide traders in navigating the market's water, and they are instrumental in making informed decisions, identifying potential trading opportunities, and also managing the inherent risks of market participation. So in a sense, understanding and applying core principles in technical analysis is fundamental for any trader aiming to decipher market dynamics accurately. And they are not just tools, they are lenses that bring the market into sharper focus, enhancing your ability to trade with confidence and precision. As we continue an exploration of technical analysis, let's delve into this insightful segmentation of the market into 6 distinct business cycle stages. This model is a powerful tool for understanding market dynamics and aligning trading strategies with economic cycles. If you remember, in our previous webinar, I mentioned this in a very, let's say, just provided a broad picture of that, and as a reason that we need to analyze the markets. And this model here you see, it breaks down the market into 6 stages, each representing a different phase of the economic cycle. And these stages are crucial for traders as they offer insights into potential market directions and appropriate trading strategies. So you can use the identification of these stages to measure the strength or weakness of a particular currency, compare to another currency that will give you a great broad knowledge about the general direction of that currency pair in the market. So let's walk through these stages. Okay, in the early recovery stage, we typically see low interest rates stimulation. You see here is the early recovery. This is the name of this stage. This phase is often favorable for equities or the currencies that are representing this economy. As we move to the economic growth phase, corporate profits and consumer spending increases, further benefiting stocks or the representing currency. So the economy booms is the third stage, brings rising inflation and interest rates, hinting at a shift towards more defensive asset classes. This is what you are seeing right now in the current economic situation. And that's the reason we usually look at the economic calendar. And that's the reason that those events like a CPI that we will see, for example, this week's CPI announcements for the Germany, for the let's say big European economies like Germany, like France, and also the PCE, the favorable measurements of inflation, the US for Federal Reserve. These can impact financial markets in a very great um, way, because you see these are the factors that usually able the traders and market participants to understand, to identify, or let's say to define the current stage of the economy, which is vital to understand the uh, stage of the currency that they are trading. Okay, so and after that, we see the economic slowdowns, the stage 4. The economic slowdown begins as interest rates peak, something that we, the many market participants, are anticipating right now. That's the, for example, interest rates in the US has peaked, and signaling caution in the markets during the recession phase, which is a stage 5. Okay, here you see declining interest rates and reduced spending typically lead to a focus on fixed income and cash. And finally, in the late recession stage, the economy bottoms out, and setting the stage for recovery and presenting opportunities for early market entry, which are gonna just turn to the stage 1. So understanding these stages allows traders to align their strategies with economic trends, and each stage offers specific insights for asset allocation and timing market entries and exits. So as you see, this diagram here illustrates this cyclical nature of the 6 stages, and notice how each stage flows into the next, highlighting the importance of recognizing and adapting to these transitions for strategic trading. In summary, mastering this business cycle stages equip you with the ability to recognize the and also adapt to changing market conditions, right? Uh, Something that we are experiencing right now in the financial market, the global financial market, by identifying key economic indicators that signal these transitions. You can make a strategic decisions about asset allocation, timing, and enhancing your trading efficiency uh, in line with the economic cycle. So here, let's delve into a critical aspect that often eludes technical charts and numbers: market psychology. It's the underlying current that can sweep the market in an unexpected direction. Let's see what is market psychology. Market psychology encompasses the collective sentiment and behavior of investors and traders. It's a powerful force that can drive prices up or down independent of fundamental factors. It's the human element in the market equation. So, key to understanding market psychology are 2 primal emotions: fear and greed. These emotions can lead to overreactions, such as rapid price spikes or drops, often followed by corrections as the market just readjusts. Another aspect is the herd mentality, where investors follow the crowd, sometimes leading to market bubbles or crashes. So in practical trading, understanding market psychology is crucial. It helps us anticipate potential price movements and make more informed decisions. For instance, recognizing a bullish sentiment might lead to identifying a potential uptrend, while widespread fear might signal a coming downturn. In a sense, incorporating market psychology into your trading strategy is about more than just reading charts. Okay, guys, it's about reading the moods of the market. It involves recognizing sentiment trends, utilizing psychological indicator, and applying this understanding to enhance your trading decisions. Uh, I, if I have a time, I will demonstrate these concepts on the real chart for you at the end of this webinar. I hope we can find some time to do that. Okay, continuing our journey through the realms of forex trading, we now turn and focus to a key concept that often dictates the pace of the market. We call it momentum. Understanding and harnessing momentum is akin to, let's say, catching a wave at just the right moment, propelling your trades with the market's energy. So, momentum, in a sense, measures the rate at which prices move over a given period. It's a powerful indicator of the strength of a trend, be it up or down, providing insights into the force behind market movements. But we really need to quantify momentum. To quantify momentum, we rely on various indicators, tools like the moving average, convergence, divergence, we know them as the MACD indicator, or the relative strength index, or RSI, and the stochastic oscillator. These are the pivotal tools that we can use them to, let's say, measure and quantify the momentum. And we will delve in great detail about how to use the best trading strategies using MACD, RSI, and stochastic oscillator in our upcoming webinars for sure. And these aren't just numbers and lines on the chart; they're gauges of the market's heartbeats. So momentum trading strategies leverage these indicators to capitalize on strong trends, and perhaps more importantly, they aid in identifying potential trend reversals, which is really, really, let's say, uh, precious for any trader, and offering critical insights into when a trend might change the course. Okay, so you will learn how we use or we hire the divergence, the concept of divergence, to identify the best confirmed reversal patterns on the chart using MACD or RSI, or as very simple or powerful tools, which are the moving averages. By the way, the practical application of momentum in trading is profound. By analyzing momentum, traders can strategically time their market entries and exits, and it's about identifying when the momentum is building up to enter a trade and recognizing when it's waning to make a timely exit, thereby maximizing potential gains and minimizing risks. So in conclusion, momentum should not be overlooked in your trading strategy. It's as important as market direction, and it serves as a leading indicator, often foreshadowing market movements before they occur. And utilizing momentum indicators not only reinforces your trading decisions, but also provides crucial insights into the best points for market entry and exit. So now let's focus on the crucial skill every Forex trader must master: interpreting price charts. This is the first, let's say, practical step that we're going to take in our introduction to technical analysis. These charts are not mere lines and bars on the screen. They are the stories of the market and narrated through price movements. Price charts are the canvases where the market's drama unfolds. If you see in this way, you can feel that they are visual representations of market data over time, essential for performing technical analysis. If you want to become a great technical analyst, so you should feel and understand these visual representations. Understanding these charts is key to unraveling market behavior. So there are several types of price charts, more than 7, each offering a different perspective. But here we just limit our journey to the most common charts: line charts, bar charts, and candlestick charts. Line charts provide a simplified view, focusing mainly on closing prices and ideal for a clear picture of overall trend direction. Also, bar charts that we have, these charts offer more details showing the opening, high, low, and closing prices. Yep. Yes. These bar charts, I was saying, show the opening price, the high price, the low price, and the closing price for each period, and giving us a sense of the market's volatility and range. And then we have candlestick charts that take this a step further. And candlestick charts not only show price movements, but also offer insights into market sentiment. With their color and formation, they also can indicate potential price reversal, which is the most precious information ever that a trader can get from the price chart. So you will see we will have a 2 comprehensive webinar about the candlestick charts. We will go through all the details about the chart patterns, about how they reveal the 2 most important information that we need to trade in financial market. First is the market volatility, and the second is the market sentiment. And we can just extract all of this information by looking at a candlestick chart at any time frame. So interpreting these charts involves analyzing patterns and indicators to forecast future market behavior, and it's about spotting trends, recognizing chart formations like triangles or head and shoulders, and understanding what these patterns could signify for future price movement. In summary, mastering price chart interpretation is fundamental to successful forex trading. It involves choosing the right chart type for your analysis, recognizing important pattern, and integrating this analysis into your overall trading strategy. For example, if you are looking to get a confirmation or make sure that the reversal patterns happened in the market, it's not the very best idea to use the line chart, because using the line chart, you may not get as much as information you may need, but you can see the broad picture or the general direction of the market, and in that case, confirming a market reversal would be really difficult. But or let's say if you want just to get a big picture of what is happening, what has happened in the market in the, for example, past few weeks or past few months or years, uh, maybe if you get yourself busy with the candlestick chart, you will see a very detailed picture with the different candles, different lines, different colors. So that may confuse you to understand the big picture. Let me just show you maybe an example here. Let me just open up my MT4. Okay. Okay, here, guys, I hope you can see my MT4 right now. Let me just make it clear. Okay. As you see, uh, for example, you can choose between different chart types in the MT4. Here is a bar chart, this is a line chart, and you see the line chart is a very simplified visualization of the price movement during the time. So you're able to understand the general market direction. For example, here I see there is a zigzag pattern going upwards, so I can understand that the market is on an let's say general uptrend somehow. And you see it means the prices are moving in a positive slope direction. So we will explain it later. But for example, here, if I turn it to the candlestick chart, you see each candle constitutes of four elements, four factors. First, this is the open price, and then this is the last price or the closing price of the current closing price of the market. And you can see this low here at this week or this lower line, we call it the shadow, and also this is the upper shadow. And you see this level uh, just demonstrate the lowest price of this session, and here we can see the highest price of the session. And by session I mean, for example, we have a 1 hour. It means this is the open price in the last 1 hour, which has begun uh, at 15 GMT2, which is the broker's watch. You can see here the broker's watch and the market watch. Okay, and when we have a closing price higher than the open price, means the market actually is going higher. So and in that case we call it a bullish candlestick. On the other side, when you see we have a closing price lower than the open price, means the some selling pressure dragged the market down. So the market ended up in a lower price closing price. So it means we had a bearish session. Okay, so this is the information we can just extract at the first glance at the candlestick charts. And moving forward, you see we have the bar charts. The bar charts, actually each bar consists of the same information as candlesticks, but because of the visualization and the way that it uh, shows the markets, we can't clearly identify the market sentiment through each bar, because for example you see this let's say vertical bar here, which represents the market range in each session based on the time frame, and you see a one little left hand here and the right hand here, which are representing the open price of this session and the close price of this session. And when we have a closing price higher than the previous session, means we have a bullish bar. And when we have a closing price lower than the previous close price in the previous session, means we have a red or bearish bar. Okay, but you can see it's really obvious that when you use a candlestick charts, you can just figure out what's going on in the market much easier than looking at the bar charts. Okay, so using the different charts, if I want to identify the general direction of the market, I prefer to use a line chart because I don't want any noises on my chart. For example, here you see a very nice lines through the upside, so I can identify the general direction. But if I need more details about the price, to analyze the market and maybe specify my entry or exit point, so for sure I need more details, so I will use the candlestick charts. Okay, I hope I could make it clear. So let's back to our slides. Mastering price charts interpretation is fundamental, as we said. So it involves choosing the right chart type for your analysis. And this skill is essential for making informed and strategic trading decisions in the dynamic world of Forex. So one of the most fundamental concepts we encounter is the trend. Understanding the nature of trends is crucial, as it sets the foundation for all our trading decisions and strategies. Let's see what is trend. A trend in forex trading is defined as the general direction in which the market or a specific currency pair is moving. So it's the narrative of the market telling us whether buyers or sellers are in control. Trends can be categorized into three types: uptrends, downtrends, and sideways trends. This is based on the market direction. But let's see what is an uptrend. In an uptrend, we see a pattern of higher highs and higher lows. And this pattern is a hallmark of increasing buyer interest and bullish sentiment in the market. Conversely, a downtrend Conversely, a downtrend is marked by lower highs and lower lows, reflecting growing seller pressure and bearish sentiment. Then there is the sideways trend also, where the market moves within a narrow range, indicating a balance or equilibrium between buyers and sellers. And these charts illustrate each type of trend, and notice how each trend provides unique insights into market sentiment and potential future movement. Identifying the type of trend is not just an analytical exercise, it's a strategic necessity. It guides us in making informed trading decisions, setting appropriate strategies, and applying risk management measures, because we can decide if we want to go with the prior trend, or we just want to trade against it, or let's say we want to become a contrary trader. So recognizing the difference between short-term market noise and long-term market movements is key to successful forex trading, because if you want to put your stop loss, or you want to define or let's say to determine your take profits. So it's very essential to know the general direction of the market. In that case, you may be able to just ignore some noises against the general direction of the market to keep your trade open until you reach your target. So let's say the problem is that the markets usually don't go in a straight line. They usually go through a zigzag pattern. So this chart provides a clear illustration of an uptrend. And notice the higher highs and higher lows, the ascending moving averages acting as support in this case, and the upward sloping trend lines and channels we can have. So when trading in an uptrend, it's important to recognize potential entry points, which often occur during pullbacks or retracements. Rising moving averages can act as support levels, as you see here, and all of these market buttons, they usually act as a support level. And in an uptrend, we expect the price to move beyond the last market top as the market resistance. And don't worry if you're not familiar with the concept of the support and resistance, because in our next webinar next week, we're gonna just break it down to you. So as you see here, when we can identify a market top and then a market bottom, as soon as we see the break above the market top, we can assume that market is going to top somewhere higher. So in that case, we can expect to have an uptrend, but it will be very, very soon to decide about the uptrend, because when we are at this stage, we need to wait for the price to see if the market can also make a higher bottom. Guys, as soon as you see one top higher than the previous and one bottom higher than the previous market bottom, so in that case, you identify this as an uptrend. And what we do in an uptrend is that we usually looking for a buy signal. We are going to enter a buy position, a long position. Doesn't matter after let's say by just rebounding from this level or breaking above this level. By the way, as soon as you identify an uptrend, always look for a buy position. On the other hand, this chart we see clearly shows a downtrend in action. And observe the lower highs and lower lows, the descending moving average we will have, and the downward sloping trend lines and channels. So in a downtrend, opportunities often arise for short selling during price rallies or for opening a sell positions in Forex. In that case, you see, as soon as the market makes the first top lower than the previous and then breaks below the last market bottom to make a lower bottom, it means we are in a downtrend. So in that case, let me repeat it, just the best scenario to follow is to looking for short sells or let's say selling opportunities in the market. But the problem with financial market is that they are not just move in two directions. There is another one. There is a third let's say situation that can decrease our chance to success considerably, and we call it sideways. Sideways demonstrate a trendless market, and Usually, sideways trends are characterized by a lack of significant upward or downward movements. They can be identified by drawing horizontal trend line, as you see, that mark the boundaries of the price range and observing relatively flat moving averages. In this case, it means it's really hard to identify the uh, successive lower tops and bottoms or higher tops and bottoms in the market. For example, you see the market just made a top here and then a bottom here and then a lower top. So we may expect to see a lower bottom, but we see a higher bottom. So in that case, we gonna get confused. Oh my God, what's going on here? So we can't identify any clear direction, and that's why we call it sideways. This is a range. And what we say to not experienced traders, we say, guys, please don't trade sideways, because in more than 90% of case scenarios, you're going to lose your money because it's really unpredictable market and it's not possible to predict, to make an educated guess that's the uh, where will be the next market stop. So that's why when trading in a sideways trend, range bound strategies can be effective only. And this involves buying at support levels and selling at resistance levels. But in reality, it rarely happens. Okay? I'm gonna tell you a secret. Uh, you might be a seasoned trader or the one that's who just entered the financial markets to pursue your opportunities, your financial goals, and you might think that it will not possible to make money in this market without following a very complex, let's say, scenarios and finding a very, very advanced material or something like that. But guys, believe me, after 10 years trading in the financial market, talking to many traders around the world, uh, I can make you sure that the most important thing, that the most essential skill that a trader should have is the sense of market structure. If you can identify the market structure correctly, you're going to be a successful trader with a proper risk management rules. Doesn't matter what strategy you use in the market, because as soon as you can identify if the market is heading uh, upward or downward, you will be one step ahead of the market. So you will be able to trade the market uh, confidently. Okay, for example, let me show you one example here on March chart. After this definition of the uptrend and downtrend, you can easily see what's going on here. And this is a gold chart in a 1 hour time frame. So you see how this is a beautiful uptrend here we have. But at this time, if you want to look for a entry, you see market is losing its upside momentum. Okay, so if you just understand the market direction at the first glance, and then you learn how to measure the momentum of the trend, you can apply your strategy on any chart, on any time, at any time frame, so you can become a successful trader. Or let's say at the pound, for example, here on the 1 hour chart. Right now, you see this is a beautiful uptrend also we see in the pound, okay? So the first, let's say the first step is just trying to understand. We are not going to trade this market right now because we don't have that equins, let's say, knowledge right now. But the vital thing is that we must be able to understand the market structure to see if this is an uptrend or a downtrend. For example, if we want to see a very, very clear uptrend, you can look at this chart here by starting from this point. You see how an uptrend has begun uh, to accelerate. Let me just change the color of this to something maybe lighter. So yeah, you see from this point, you see the market bottoms. It's very, very easy to understand. You see, and you also see the market tops. Let me change the color of tops to something different. For example, here. And you can understand that this is an uptrend. So in an uptrend, after these two tops and bottoms, you can just look for markets, let's say, buy positions. Okay. On the other side, you see a beautiful downtrend. Of course, it's not gonna be just as simple as what we see in a graph, in a model graph, because in a real market we have a lot of emotions participate in the market, and with a lot of risk associated, a lot of real time news and events okay, involved in the market. So that's why we see a lot of noises. That's the reason we see all of these different candlesticks here. But don't worry about that. At the end of this package, you will be able to read the market psychology behind each of these candles, and you will find that confident to understand the market very, very easy. So this is the first lesson right now, that what is the market range. For example, here you see the market doesn't move always in upward or downward direction. There are times that we see the market is moving sideways. So during the sideways, we usually recommend not to trade the markets, but maybe only use the range bound strategies. Okay, so here is the example of the range market, and here you see an example of a downtrend. Or a better example, maybe here, lower tops, guys, lower bottoms. As you see, lower tops and lower bottoms. So this is a downtrend, and the end of a downtrend is when you see there is no lower bottom more. So it means we are at the last stage of a downtrend. So after this, the downtrend just disappeared because we can't identify any lower low. So we are not, we will not look for any, let's say, more sell position here in the market, okay? So this is, I just wanted to show you the, let's say, the real market action and how you can identify the range, the uptrend and downtrend in the market. But let's back to our slides here. We're running out of time. So we now turn a cornerstone concept in market trading, the analysis of trends. This nuanced understanding of market trends is fundamental to forecasting market direction and developing effective trading strategies. From the other perspective, I mean, not the fundamental concept of market direction, but the market time lap. We can categorize market trends into three types: primary, secondary, and minor trends. Each of these trends operates within a specific time frame and plays a unique role in the broader market context. For example, understanding and identifying these trends is crucial for traders. It's about knowing where we are in the market cycle and, more importantly, where we are heading to. So this insight is pivotal in making informed trading decisions, be it for long-term investment or short-term speculation. Let's break them down. Primary trend the first. Primary trends represents the long-term market direction stretching over several months to years, okay? And they reflect the overall market sentiment. The secondary, we have uh, secondary trends. The second is the secondary trends, and these are the medium-term movements, often corrections or counter trends within the primary trend. These can last for a few weeks to several months. Lastly, we have the minor trends. These are short-term fluctuations. They are often seen as market noise within the secondary trends and are more relevant for short-term traders. The one way to understand these different market time lapse is using the different time frames. For example, let me show you on the MT4. For example, it's a USD CAD on a weekly chart. In a weekly chart, it means from the in a past year, from the earlier of October 2022 till now, which is the November 2023, we see the market has been in a range. Right now, you totally understand the market direction. So this is a range because we can't identify clear successive higher or lower tops and bottoms. So we call it the market range. Okay, but let's just break it down to a daily chart. On a daily chart, you see we have some rallies, yeah, like here, and some corrections like here, and somehow the market which is trying to change the mood from this top and want to turn to the downtrend. Or you might be able to visualize this, for example, uptrend after just identifying these higher tops like here, here, yes, and this is an uptrend. So this is a good example of a secondary trend, maybe, which has lasted for almost 3 months, okay? But we have also some noises, some minor trends in the market as well. So if I want to, for example, just look at this uptrend here, yeah, let me just change the color. And go to the lower time frame to see the market noises on a 30 minutes time frame. It was too much, yeah. From here, you can see we have a period of market going upside, and then we see kind of a correction to the downside, and then you see during this just secondary, we can also, let's say, explain it as a market range as well. For example, for some times, for in 14 July 2023 till 31 July for 2 weeks. Okay, and then we see an uptrend and then a correction during that uptrend in a secondary move. We have this market correction here to the down. So this is a market noises, guys, and we can understand it as a minor trend. And you see, even after that, we can see a very, very large downward movement here. So this is an example of how these three types of trends are working together, are they are blended. And in summary, trend analysis in this methodology is about more than identifying lines on a chart. It's a strategic approach to understanding market movements by utilizing trend analysis. So traders can align their strategies with long-term market directions and capitalize on medium-term corrections and navigate short-term market fluctuations effectively. And this is the way that we will illustrate it in a very great examples in our coming webinars. So I ran out of time, guys. By the way, if you have any question, just write it down to me. I would be more than happy to answer them if I know. So please don't hesitate to send me any question you may have. Okay. Okay. We have a question from Mr. Muhammad. Okay, what is the importance of momentum in trading and how is it measured? Okay, I explained, Mr. Mohammed. Momentum is important because it reflects the velocity of price changes and can indicate the strength of a trend. It is often measured using technical indicators such as the relative strength index, RSI, we know it as RSI, and moving average convergence divergence, or MACD. These indicators help traders identify overbought or oversold conditions and potential trend reversals. There are also other techniques with the price action methods that I can just show you then in our next webinars. Okay, we have another question. Should we enter on a primary, secondary, or minor trend? Very good question from our friend, Mr. Otman. And how trading decisions can be placed accurately at each stage? Perfect question. There are different strategies. Okay. Yes, Mr. Otman, there are different strategies to trade based on the, let's say, different types of trends. The most important thing is that it depends on your trading style. If you watched our previous webinars 2 weeks ago, we were talking about trading styles and its importance to just allocate the reasonable time and capital to follow the market based on our characteristics, our personal desires. I mean, for example, if I am, let's say, swing trader, I may look at the secondary trends. If I am a position trader, I may look at primary trend. But if I'm a scalper or a day trader, I usually prefer to trend with minor trends. But there is two different ways to manage the trade, a trade when we want to, after choosing our trading style. When we want to trade based on our style, but taking advantage of the different market stages. For example, here in my example, you saw on a, for example, daily charts. I show you this is a range. So if I am a position trader, I may prefer to find maybe a buy position around here after occurring this double top. This is a reversal, bullish reversal pattern. So that would be the case. I might find a way here. And in that case, I will ignore all of the market corrections until I see the price get to the upper edge of this range bound. Okay, if I am a position trader. But if I am a day trader or a scalper, I might prefer to look at the big picture first to understand the general market direction. For example, in this case, you see, I look at the, for example, daily chart to see, okay, here we are on a 4-hour chart. I understand that this is let's say a general uptrend here, but I can choose to trade against this secondary trend or in favor of this secondary trend. It means I can wait for the price. This is a very simple strategy. I can use the moving average 50 length. Okay, here you see, and I can wait for the price to get to above, too far from the moving average in the, on the upside. So then I may try to just spot a sell position during the market direction. That's the thing, okay? Because we have, for example, a trend line from a secondary trend, so I can identify any correction and target this trend line again, because I can be sure that the minor trend is the less strength than the secondary trend. This is a one strategy. Or I can look at the big picture in the secondary trend and then look for a entry on lower chart frames. It means I'm trying, for example, here, I understand that the market direction is upward, but I'm looking for the best price to buy. So I can just, for example, jump on the shorter time frame to see what I can get. For example, I see the price is in this stage. May wait for the price to drop to the line, and then after this rebound and this rebound coming above the moving average, and then I can say, okay, this is a fair price to open a buy position. And also in that case, when I want to hold my position as a day trader, maybe I don't mind if I see this market correction, or any of these pullback to the moving average will be a chance to exit the trade. Okay, so this is a different strategies to enter the market. And also we can apply different strategies to manage our risk. That's another thing. Okay, for example, you can just minimize your risk by waiting for the price to hit any resistance or support level from the higher time frame, as you recognized already as a key levels of the primary or secondary trends. So that's the way. I hope I could answer your question, Mr. Othman. And there is and also another question. Okay, thank you so much for your confirmation. And another question is that what time frame should make my trends? Mr. Ita asked this question. I think I may answer that question. Yes, so you can look at the primary trends and then look at the secondary trends, but make your decisions in a minor trends if you are a scalper or day trader. But if you are a position trader, you may use the primary trends using the higher time frames, like a weekly charts, for example. Okay, another question arises is that which combination of indicators is the best? This is a very great question. Let me don't go through the nuanced answer for this question, if you excuse me, Mr. Uthman, because we have a comprehensive webinar about this concept of the indicators. But in that case, to answer your question, I would say the best indicators, best combination of indicators, I would say you need just two things to be defined in your trading journey. First is market direction, and second is market momentum. Okay, so I would say the best indicator to use is the price. Price is the best indicator to use. If you look at the price carefully, you will be able to identify the market momentum using the arts of candlestick chart pattern analysis. And also you will be able to identify the trends, the direction of the markets using the shapes of the price charts and the zigzag patterns. Okay, so, but if you want to make sure that if your educated guess is more probable to be true than wrong, so yes, the first thing is using the moving average. I usually recommend that. And you just need one momentum oscillator. It can be relative strength index, it can be momentum oscillator or MACD. One of these that you are more comfortable with. And also it somehow depends on the instrument that you are trading. So if you can hold this question for some days, Mr. Othman, we will delve into a great nuance of how higher combination of oscillators in our next webinars. Okay, that's great. Any other question, guys? Thank you. Thank you so much. Thank you for staying with me till this late. And I hope to see you all next week in the next webinar. Thank you so much. Enjoy your evening. Have a great day.